How much are you willing to pay to save money on taxes? It sounds like a trick question, doesn't it? But for so many of you who are retired or just a few years away from it, this is the reality of the Roth Conversion Trap. You've been told, and correctly so, that moving your money from a traditional IRA to a Roth IRA is a brilliant move. You pay the tax now, the money grows tax-free, and you never have to worry about the IRS again. But there is a hidden predator waiting in the grass, and its name is IRMAA. If you don't know what IRMAA is, you need to listen closely, because she can take a massive bite out of your Social Security check before you even see it. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a fancy way for the government to say, because you made more money, we are going to charge you more for your Medicare. Here is the problem: when you do a Roth conversion, every dollar you move counts as ordinary income. If you move $50,000, the IRS sees that as $50,000 of income. And if that income pushes you just $1 over a specific threshold, you trigger the IRMAA surcharges. Your Medicare Part B and Part D premiums won't just go up a little, they can double or even triple. And here is the fear that keeps people up at night: the 2-year lookback. Medicare doesn't look at what you're making today to determine your premiums. They look at your tax return from 2 years ago. So, if you do a big Roth conversion today in 2026, you might feel like a genius, until 2028 rolls around and you get a letter in the mail telling you that your Medicare premiums have skyrocketed because of a decision you made 2 years ago. Let's talk numbers, because you have to be a master of your own money. For 2026, the standard Part B premium is about $202.90. If you are a single filer and your modified adjusted gross income, your MAGI, is $109,000 or less, that's what you pay. But if that Roth conversion pushes your income to $109,001, just $1 over, your premium jumps to $284.10. That is an extra $974 a year. If you are a married couple, you both pay it. That's nearly $2,000 gone. And it goes up from there. At the highest tier, you could be looking at paying over $600 a month per person for Part B alone. You have to ask yourself, is the tax-free growth of the Roth worth the immediate tax of higher Medicare premiums? Sometimes the answer is yes, but you cannot make that decision blindly. So, what is the actionable takeaway here? How do you protect yourself? First, you must know where the cliffs are. In 2026, those cliffs start at $109,000 for individuals and $218,000 for married couples. If you are planning a conversion, you must calculate your other income first, your Social Security, your dividends, your interest, and see how much room you have left before you hit that cliff. If you have $10,000 of room, don't convert $15,000. It's not worth it. Second, consider the silver years, that window between the time you retire and the time you start Social Security or Medicare. If you are 62 or 63, this is your golden opportunity. Remember the 2-year look-back. If you do your heavy conversions at 62, they impact your 64-year-old self, who isn't on Medicare yet. But the moment you hit 63, every dollar you convert is being watched by Medicare for when you turn 65. Third, if you've already made a mistake and you're facing an IRMAA surcharge because of a life-changing event, like retiring or losing a spouse, you can appeal it using Form SSA 44. But be warned, a Roth conversion by itself is usually not considered a life-changing event. The government considers that a choice, not an accident. You have worked too hard for your money to let it be drained by surcharges you didn't see coming. You must be the one in control. If you're going to convert, do it with your eyes wide open. Know your brackets, know your cliffs, and for heaven's sake, don't cross them for the sake of a few extra dollars in a Roth. Stand in your truth. Be strong with your planning. And most importantly, stay informed. With that said, thanks for watching, and until next time.